This is Jonathan Lopez with the Intelligent Investor, and we're going to do a tutorial for the homework number 3, which is the final project. And you're going to see that the homework is really to a large degree a combination of homework number 1 and homework number 2. So here's the spreadsheet that we're going to use. And so the company we're going to do today is Union Pacific, which we're continuing on from homework number 2. We did that company as well, and it looked pretty good. So let's put it together for the final project. Union Pacific, symbol UNP. They are a railroad, and their market cap, we don't have to go over this again. If you need help with this, look at our tutorial for homework number 1. So we're just going to pull it right off of the homework. Market cap is 79.17 billion. Put that right here. Their rank in their industry is number 1. Their debt to equity ratio, again from the homework, 0.74. Their coverage, 12.11. And their current ratio, 1.55. How long have they paid a dividend? Since 1984. And their earnings have been positive in each of the last 10 years and have grown at an impressive rate of 18% per year on average. Yes, 18%. Okay, so that is from homework number 1. Now we're moving on to our findings from homework number 2, and we have an earnings estimate of 520. So I'll put that right there, 5.20. And we have a PE multiple. Our estimate of the multiple is right here, 17.22. So that gives us a value estimate of 89.54, and the current price is 94.14. Actually a little bit higher than our value estimate, which is interesting because when we did the homework just 2 weeks ago, the current price was 86.50. If we were smart, we would have bought it then. And now it's gone past our value estimate a little bit. So anyways, let's keep going. The dividend yield on this stock is right here from homework number 1, 2.39%. And so that would give us a total return of 20.39 because of that really high earnings growth number. I think maybe we ought to temper this down a little bit, which we actually did when we did homework number 2. We put our earnings growth 8%. Alright, so let's temper it down to 8%. If we do better than that, we'll be pleasantly surprised for an estimated total return of 10.39%. Okay, now here's something new that wasn't on either homework, was the margin of safety. So we need to start with last year's earnings. So if we go to Yahoo, right here on the front page is diluted earnings per share, which is the most recent earnings number, and we could use that, 536. And then we're going to have to figure out the 10-year AAA corporate bond yield. And so if we go to finance.yahoo.com and we go finance.yahoo.com/bonds/composite bond rates, we're going to get this screen here. And if we scroll down past treasuries, past municipals to corporate bonds. We want the 10-year AAA bond yield, which is 1.94. Okay, so that's what we're going to put here, 1.94. And so that we're going to have a margin of safety at 3.75, which is pretty good. It's almost 4. And if generally our portfolio is giving us a margin of safety of around 4, we should be happy. So what we found here for the final project is a company in Union Pacific that is large, market cap over 10 billion, prominent number 1 in their industry, conservatively financed, and you could tell that because their debt to equity ratio is less than 1, coverage is greater than 5, and their current ratio is greater than 1. They paid a dividend since 1984, and they have solid earnings. Okay. When we value them, initially when we valued them, their current price was under that. We might have to wait for come down a little bit before we see an attractive entry point. And our total return we would expect if we held on to this as a defensive investor, probably in the 10 to 11% total return range, which if we're happy with that, then that might be a good company. Now, so the margin of safety is the earnings yield minus the bond yield, and we want that to be around 4 or better, which 3.75 is not too bad. So that's how you do the final project homework.